Every time a truck rolls across a state line, a jet lifts off the runway, or a factory floor sparks to life in America, there's a hidden engine powering it all, one that few Americans ever voted on: cross-border energy dependence. Beneath the noise of consumer goods and trade deals lies a massive, invisible artery: Canada's oil supply. At the heart of this quiet interdependence is a trade agreement never formally endorsed by public mandate, yet it drives over 4 million barrels of oil into the U.S. daily. Now, that silent arrangement is under direct assault. Canada's representatives are pushing back hard after the U.S. levied 25% tariffs on Canadian imports. While Canadian dairy products already face tariffs as high as 250%, an imbalance now spiraling into political retaliation. Canadian leaders have responded with uncharacteristic urgency. As one put it, fighting back against U.S. tariffs and protecting our workers are our most immediate priorities. This isn't just rhetoric. It's a shift toward protectionism at a structural level, and it's happening one pipeline at a time. The fragility of this dynamic exposes a stark truth. A single policy shift, not debated, not televised, can cascade into macroeconomic consequences. When trade becomes weaponized, infrastructure becomes collateral. Over 3 million barrels of oil move from Canada into the United States every single day, not with headlines, not with celebration, but quietly, automatically, invisibly. This is not just trade, it's infrastructure. It's not a news item. It's the circulatory system of the U.S. economy. But in early 2025, that flow was jeopardized by a sentence that didn't even make it to primetime television. Tomorrow, tariffs 25% on Canada. It wasn't yelled from podiums, it leaked, quietly, strategically. Energy products would be hit with a 10% tariff, a move widely regarded as unjustified and a clear violation of the North American Free Trade Agreement, NAFTA. Markets didn't need an official press release, just the implication was enough. Behind closed doors, the phrase began to circulate among policymakers, CEOs, and economists. What if Canada pulls the plug? What if the most important foreign energy source for the United States, one responsible for fueling refineries, logistics networks, and heavy industry, suddenly shuts down? This wasn't a rumor. It was a strategic red line being tested. In a moment, oil stopped being a commodity and started being a weapon. Oil weapon. Two words that rarely belong in the same sentence. Until now. What if your next gas station visit cost twice as much, and no one explained why? What if one policy decision made hundreds of miles away could rewrite the cost of everything you touch? Gasoline, groceries, electricity, industrial production? That's not paranoia. That's modern geopolitics powered by pipelines. In early 2025, that hypothetical scenario nearly came true. Not a single barrel was stopped. No official blockade. And yet, the United States came dangerously close to an energy meltdown. It wasn't about what Canada did. It was about what Canada could do. And that was enough to force Washington into retreat. This is what credible deterrence looks like in a globalized energy economy. The U.S. didn't step back out of diplomacy. It stepped back because it understood the price of escalation. Nationwide inflation, market chaos, and irreversible political backlash, all from one turn of the valve. And here's the part that should concern every informed citizen. You're hearing this before most people ever will. Because when power shifts quietly, it doesn't come with breaking news. It comes with consequences felt long before they're ever explained. That you're hearing this now? That's not by accident. Some content offers trivia. This recalibrates your perception of power. The conflict began as many trade wars do: loud threats, retaliatory tariffs, headlines that flare and fade. But underneath that predictable chaos, a different game was unfolding, one with strategic discipline, not just posturing. When Donald Trump returned to office in January 2025, his administration moved fast. Emergency orders, broad-based tariffs, public declarations of strength. A familiar playbook, but this time there was one crucial deviation. Among the sweeping 25% tariffs on Canadian imports, one line stood out: only 10% on Canadian oil. That wasn't a compromise. It was a calculated restraint, a deliberate decision to pull the punch when it mattered most. Because while aluminum and lumber spark headlines, oil drives economies, and Trump's advisors knew something the public did not. Pushing too hard on Canadian oil wouldn't win a trade war. It would trigger an energy crisis. In geopolitics, knowing where not to strike is as critical as knowing when to escalate. And in this case, Trump didn't back off because he was soft. He held back because he understood how deep America's dependency runs. Because the U.S. can't survive without it. That's not an exaggeration. That's the logistical truth. Canadian oil isn't a bonus, it's the foundation. It accounts for nearly 60% of all U.S. oil imports, more than OPEC, Mexico, or any other country. This isn't just about volume, it's about compatibility. The U.S. refining system, especially across the Midwest, was built not simply to process oil, but to process this oil: heavy, thick, chemically specific Canadian crude. You can't substitute it with Texas light sweet crude. You can't reroute Venezuelan or Saudi oil into the system and expect it to run seamlessly. The machines aren't interchangeable. The chemistry doesn't lie. And yet, most Americans don't know this. And those who do, they rarely talk about it. Why? Because dependence isn't something policymakers like to admit, especially when that dependence leaves no room for error, no plan B, and no political cover if the system fails. At first, Canada responded by the book. Tariffs on agriculture, metals, the standard countermeasures in any trade war. But by March, the tone shifted. Canada stopped reacting and started posturing. And then, one sentence changed everything. In a remark that was anything but accidental, Canada's foreign minister let it slip. Of course there's oil and gas. We kept that in our cards. A statement not shouted but placed, like a pin dropped in a glass room. Energy traders understood instantly. This wasn't negotiation. It was escalation. Not emotional, not chaotic. Quiet, surgical, lethal. And although the threat remained hypothetical, markets didn't care. In the world of commodities, fear is priced in long before action ever happens. The price of Canadian crude, Western Canadian Select, WCS, surged overnight, and U.S. refineries scrambled to secure barrels in anticipation of what might come next. Because in oil markets, even an unspoken threat carries economic weight, especially when it comes from a supplier that holds both the pipeline and the leverage. As Canadian crude prices surged, U.S. refineries began stockpiling, bracing for the worst. But it wasn't just refineries reacting. Calls flooded into Washington from CEOs, energy lobbyists, and logistics executives, all sounding the same alarm. The fuse was short. Danger was imminent. There are a few things that keep presidents awake at night. A full-blown oil supply shock in an election year is one of them. Not because it's an energy issue, but because it's a voter issue. It hits wallets, it shapes headlines, and it moves polls. If you're still watching at this point, you're not here for entertainment. You're here because you sense what most people don't. Power doesn't disappear. It just shifts. And those who understand how it moves, quietly, structurally, beneath the surface, often have more influence than the ones publicly holding it. That realization didn't hit Washington through a headline. It came in waves, through back channels, urgent memos, and internal briefings. And just days after the initial market tremor, policymakers knew this wasn't posturing. This was strategic vulnerability, and it was real. As the pressure mounted, it turned surgical. In March 2025, Canada's Energy Minister, Jonathan Wilkinson, stepped onto the stage at CERAWeek, a high-stakes global energy conference known for shaping the industry's next moves. His audience, oil executives, institutional investors, energy analysts, and, quietly, Washington's top watchers. Wilkinson's delivery was calm, deliberate, and encoded. We're not looking for an escalation, but we have options. Just 9 words, no threat, only implication. And in geopolitical strategy, implication is everything, because the strongest move isn't the one you play, it's the one they think you might. Within minutes, the message reverberated across energy desks and policy rooms. Wilkinson wasn't bluffing. He was telegraphing leverage, subtly, legally, and with maximum psychological impact. This was no longer a commodity dispute. This was about positioning, about signaling intent without provoking escalation. And it marked a pivotal moment. The U.S.-Canada energy relationship, once seen as untouchable, was now in the open, strategized, scrutinized, and, for the first time, vulnerable. For decades, the energy relationship between the United States and Canada was considered untouchable, sacred beyond politics. Since World War II, no Canadian government had ever even suggested weaponizing its oil exports. The red line had never been approached, until now. And the moment Canada stepped near that line, everything reacted. Markets didn't wait for confirmation. They priced in the possibility before a single policy changed. The price gap between Western Canadian Select, WCS, and West Texas Intermediate, on WTI, normally a stable $15 spread, collapsed to single digits. For context, that gap hasn't dipped below $10 since 2018, and when it has, it was always due to crisis. This time, there was no disruption, just the threat of leverage. And that was enough to trigger a 5-alarm fire on trading floors. Because in energy markets, perception is currency. And when a long-held assumption that Canada would never use oil as a bargaining chip gets shattered, the system doesn't wait to see if it's true. It moves. In market terms, it wasn't just volatility. It was a 5-alarm fire. And not because of what had been said, but because of what could happen if the wrong piece on the geopolitical chessboard was moved. U.S. refiners began hoarding Canadian oil as if it were about to disappear overnight. Because in the world of energy, when geopolitics enter the room, supply chains don't argue. They move, and they moved fast. Behind closed doors, panic was spreading. The American Petroleum Institute, API, began issuing urgent briefings to the White House, alerting policymakers to what insiders already knew. The margin for error was gone. Meanwhile, refinery CEOs were lighting up back channels, quietly coordinating contingency plans with suppliers, hedge funds, and government contacts. You didn't see it on cable news. But behind the curtain, the people who move billions were already scrambling. Not because of a disruption, but because of the probability of one, and that probability was no longer hypothetical. Here's the reason panic spread so quickly. Yes, the U.S. Strategic Petroleum Reserve holds 350 million barrels. That sounds vast, until you factor in reality. At current consumption rates, that's less than 3 months of partial coverage. And keyword, partial. You can't drill your way out of that, not overnight. You can't buy American either, because the pipelines flow one way, north to south. This isn't a logistics inconvenience. It's a structural dependency. Refineries in Michigan, Ohio, and Pennsylvania weren't just built to process oil. They were built to process Canadian heavy crude, specifically engineered for its density, chemical profile, and flow properties. That's not a flaw in the system. That's the system. It's the result of 30 years of economic entanglement, interconnected investment, supply integration, and cross-border specialization. There is no switch to flip, no backup tank, no emergency route, just pipelines, and the assumption that they'll always be full. There's an unspoken assumption in American energy. The pipelines will always be full. But that assumption doesn't live in headlines. It lives in the shadows, in the back rooms where decisions are made before the public catches up. If you're here now, you're already ahead of the curve, whether you plan to be or not. And this moment isn't just about infrastructure. It's about math. If Canada were to even partially shut the tap, U.S. gasoline prices would spike by 30 to 50% in a matter of weeks. That's not speculation. That's the conclusion from Trump's own economic team, buried inside confidential briefings. This wasn't just a diplomatic inconvenience. It was a ticking price bomb, one that threatened to cripple consumer confidence, destabilize supply chains, and shatter political momentum in an election year. And in that math, gas price volatility, refinery constraints, strategic reserves, there was one silent variable: Canada's restraint. A restraint that markets couldn't quantify, but governments couldn't ignore. This wasn't just a diplomatic inconvenience. It was a political nightmare. An oil shock in an election year is enough to do three things: tank consumer confidence, crater approval ratings, and bury a campaign. So while Trump roared on camera, projecting strength and defiance, his team was quietly dialing back the pressure. Not out of goodwill, out of survival. Because behind the noise, they understood a truth no one wanted to say out loud. Canada had leverage, and it was no longer theoretical. But as Washington scrambled for off-ramps, something unexpected happened. Canada began fracturing from within. The threat to weaponize oil had become radioactive, not just in global markets, but inside Canada itself. When geopolitical pressure meets domestic fragmentation, the equation shifts. Not because the threat disappears, but because its cost becomes harder to contain, internally and internationally. And for the first time in the crisis, the story started to bend in a different direction, from external escalation to internal dissent. The threat to weaponize oil wasn't just controversial on the world stage. It became radioactive at home, especially in Alberta, the beating heart of Canada's energy engine. Alberta produces over 80% of Canada's oil. It doesn't just contribute, it feeds the pipelines. And when Ottawa floated the idea of cutting exports to the U.S., Alberta didn't play along. Premier Danielle Smith didn't hedge her position. She called the proposal unacceptable, stating clearly that her province would never allow it. Not because she sympathized with Trump, but because Alberta's economy depends entirely on keeping those barrels moving. And that's the part few outside Canada fully grasp. The energy relationship between Canada and the U.S. isn't just geopolitical, it's regional, asymmetrical, and deeply entangled. When Ottawa speaks for Canada, it often forgets that Alberta speaks for the oil. And when energy policy collides with economic survival, national unity becomes negotiable. Here's the inconvenient truth: 97% of Canadian oil exports go to the United States. There is no plan B, no queue of global buyers, no armada of tankers waiting in the Pacific. Just a continent-spanning infrastructure system, as rigid as it is efficient. If the U.S. stopped buying, Alberta wouldn't just slow down, it would collapse. Not rhetorically, economically. Canada lacks the domestic refining capacity to absorb that oil. It has no operational pipeline to Asia. And even if it broke ground tomorrow, it would take years to reroute the flow, if the economics even made sense. The pipes run south, and so does the money. This is the fundamental asymmetry at the heart of the crisis. The U.S. is addicted to Canadian oil, but Canada is equally addicted to the American customer, and that means no side can pull the plug without pulling down the system with it. In geopolitics, leverage only matters if you can survive using it, and for Canada, the cost of pressing that button was never military, it was economic implosion. When Ottawa floated the threat of shutting off the taps, Alberta knew exactly what it was: a bluff, and a dangerous one. Like threatening to detonate a bomb in your own house just to make your neighbors nervous. Because that's what it was: economic self-harm masquerading as leverage. Economists saw it immediately for what it was: a textbook case of mutual economic hostage-taking. The United States couldn't lose Canadian oil without triggering a domestic energy crisis. Canada couldn't survive losing the U.S. as its sole customer without imploding its core export economy. Both sides had the power to destroy each other, but neither had the means to win. This wasn't trade friction. It was economic, mutually assured destruction. Not with missiles, not with weapons, but with barrels, with dependency, with silence. And that silence? That's what made it more dangerous than any public declaration. Not missiles, barrels. Trade economist Daniel Treffler captured it best. Canada threatening to cut off oil is like sawing off the branch you're sitting on while your neighbor is sitting next to you. It was geopolitical theater with a blade too close to the bone. And just when it looked like rhetoric might spiral into reality, everything shifted. In mid-March, the political surface finally cracked. Prime Minister Justin Trudeau was gone. And in his place, Mark Carney, former governor of the Bank of Canada, former governor of the Bank of England, a global finance titan, not a career politician. His tone? Sharper, colder, less democratic, more deterministic. This wasn't the language of public persuasion. This was market signaling, the kind that moves bond spreads, not ballot boxes, the kind that makes capital reevaluate risk. For the first time in the entire crisis, the message from Ottawa wasn't political. It was financial, and that made it even harder to predict. In April 2025, the silence was the message. While Trump rolled out a new wave of global tariffs, Canada's name was missing. No announcements, no escalation, just omission. Senior U.S. officials later confirmed what markets already suspected. Canada and Mexico had been quietly exempted. There was no apology, no press release, just a strategic retreat, silent, surgical, and entirely calculated. Why? Because the White House understood that America's energy architecture couldn't withstand retaliation. This wasn't about negotiation. It was about avoiding collapse. Cutting off Canadian oil would have hurt the U.S. more than any strategic win could ever justify. And so, for the second time in a single quarter, the United States blinked. Not because it lost, but because it realized what it truly stood to lose. By mid-April, the market had stabilized, not because the crisis was solved, but because it had been contained. Canada's oil kept flowing, the taps stayed open, and America, at least for the moment, exhaled. Investors stopped hoarding. The WCS-WTI price gap crept back to familiar territory. Refineries slowed their panic buys, and for the average American, gas prices ticked up slightly. Just 5 to 20 cents a gallon. Noticeable, but not riot-worthy. But the real damage wasn't economic, it was psychological. For the first time in modern memory, Americans realized that energy independence was a myth, that pipelines weren't just infrastructure. They were exposed arteries, and Canada had its hand on the pulse. Even without shutting anything down, Canada had demonstrated what would happen if they ever did. That's not policy. That's leverage. By January, Canada's export data reflected a temporary surge. But by March, growth had hit a wall, flatlined. To prevent a full economic stall-out, the Bank of Canada slashed interest rates from 5% to 2.75%. The goal wasn't to stimulate growth, it was to keep the lights on. It worked. Barely. This wasn't normal monetary policy, it was triage. But while the numbers offered temporary relief, they couldn't cover the deeper shift happening underneath. A mutual recognition that this isn't just a commodity relationship anymore. It's existential. The U.S. and Canada are no longer just trading partners. They are codependent systems, interlocked through infrastructure, refining chemistry, and economic inertia. Neither side can afford a rupture, and both now know the threat of disruption is just as powerful as disruption itself. And as markets quieted and pipelines resumed steady flows, one question began surfacing across boardrooms and war rooms alike. If this was just the rehearsal, what happens when someone finally plays it for real? The taps stayed open, the barrels kept flowing, The headlines faded, but beneath the surface of international relations, something broke. What collapsed was the assumption of immunity, the idea that a system this large, this integrated, was too stable to be weaponized. In 2025, the world learned otherwise, because when Canada, a nation defined by diplomacy, even considered turning off the tap, global markets reacted as if it already had. It didn't take action. It took possibility. That was the shift, from supply to strategy, from flow to influence. And now every policymaker understands. Energy infrastructure isn't neutral. It's leverage, even when untouched. The United States didn't fight back. It backed down, not because it was weak, but because it was exposed. There was no backup plan, only addiction. And addictions don't end with threats. They end with withdrawal, cold, chaotic, and always too late. This wasn't just a political standoff. It was a redraw of the global energy map, a moment where national power wasn't measured in troops or tweets, but in pipes, ports, and pressure points. The U.S. dodged the crisis this time, but the leverage didn't disappear. It's still there, humming beneath your roads, flowing beneath your home, embedded in your supply chains. And the next time pressure returns, it won't come with warning. It will arrive through infrastructure, already in place, already in play. This system, energy, trade, infrastructure, only works until it doesn't. It runs on silence, on assumptions that pipelines stay open, that partners don't leverage pressure points, and that supply is guaranteed by reputation. But 2025 changed that. You weren't supposed to hear any of this. Not the vulnerabilities, not the internal memos, not the quiet panic across both borders. But now that you have, there's no going back. Because once you understand how pipelines shape politics, how refining capacity constrains sovereignty, and how leverage hides in logistics, you see the global economy differently. Most will turn this off and forget. They'll remember the headlines, tariffs, press conferences, a diplomatic standoff, but they won't remember the pressure points. You will. Not because you're smarter, but because you're paying attention. You're not here for spin, you're here for signal. And here's the clearest signal of all. In this system, the first to understand where the vulnerabilities are holds the advantage, not through control, through clarity. Because in energy, what matters most isn't who owns the oil, it's who controls the flow. And when that flow becomes uncertain, markets don't wait, governments can't stall, and public trust doesn't rebound. That's the story no one wanted to tell, but now you know.